Let's get going, guys. So today we're going to talk about real estate investments. Basically, is for those who are buying for long-term, sits on properties, not flippers, and it's for apartment buildings. It's for commercial, basically commercials, but also in many times, and that's very important for us, the residentials, many investors buying single duplexes, triplexes, and fourplexes at the same manner, the same way, they thinking the same way as buying a 100-unit apartment building, and so on and so on. So I want you to understand exactly, I want you to, a lot of things going on here. I want you to understand exactly the philosophy behind this. We're not going to go too deep into GRM and all that complicated factors that goes into the analysis of this. I'm going to give you the basic. It's going to be easier for you that you will be able to go ahead and understand. Now, the reason I want you to understand is because I want you to be able to converse at least for a certain amount of understanding to converse with your clients. Let's get going. Great. Okay. So 4 main reasons why investor buying and holding long-term investment. The first one is cash flow. Like everybody understands, cash flow, money in the pocket. They care about what's left after everything. Which I love. This is something that I love the most. Basically, it's for the simple investor. A lot of mamas and papas, this is how they doing it. This is not about, everybody likes money in the pocket, the cash flow, but institutional investors are thinking differently. But most of us, we're going to deal with a lot of people which are very interested about the cash flow, the money in the pocket. The second thing, so this is one thing out. The second thing is appreciation. Okay? So what does mean appreciation? You bought a property for X amount of dollars. Throughout the years, it goes up in the value. Now they will have a Y amount of dollars, the value. So that's the delta is the appreciation. The delta is the differences between what you bought it. You can't hear me? No, but on the individual machines you can. So open your machine. Okay, sorry guys. That's appreciation. That's, everybody likes appreciation, even the mamas and papas, but appreciation is good for people who's holding a large portfolio and they, for example, publicly traded companies. For them is appreciation is a real factor. And then they're going and doing certain calculations which basically substantiate the value of the stocks. The third one, it's everybody loves it. It's depreciation. Basically, what does mean depreciation? Depreciation is monkey business with the taxes. Okay, this is what it is. It means that you have. I missed that. What is that called? Basically, it means that you have a tax deduction expense that you actually don't put money out of your pocket for this expense, and it brings down your tax liability. This is a great one, and every time that you have something that it's over a year, you're holding something for over a year, you can start depreciate, and I'll show you later. Everything that I'm showing here, I'm going to show you later. The last one for today, I mean, not there are many other reasons why people doing long-term investments, but the last one, but not the least, is the option to do a tax deferment. It's basically, like everybody says, it's the 1031 exchange. That's the IRS code. So that's the 4 main reasons. Let's get going on how we're looking on each one. Pay attention, open your eyes, have another sip of the coffee, and hold your pen if necessary. So here's a little bit of analysis of something we buy as a long-term investment. So just to go to this, Over here we have a purchase price. So this purchase price was $3,050,000. Down payment, it's very, very important. Oh, hold on for a second. Hold on. Sorry, I was waiting for a phone call from the bank, so I thought that's the one. So the down payment, it's very, very important. What is the amount of the down payment? And I'll get back to you in a second. Interest rate, then naturally the lower the interest rate, the better return somebody else have. Other stuff, I mean, you have a GRM, we're not going to talk about it, but other stuff that we have here, it's the price per unit. I mean, when we have a multiple. This one, for example, is 27 units. It's in the back end. You have that thing. So we calculate the price per unit. Everybody wants to see the price per unit. Okay, so this is important stuff, and put it down because we're going to go and address this again. Now, we have a scheduled gross income. So this is, verify the gross income on this property. Right now is $309,000. It depends on the property, but we always have to allow some vacancy allowance. In a large property, we put 5%. In a smaller property, it goes higher because naturally, when we have less apartments, if you have one vacancy, it's affecting the percentage. So in this case, we have 5% vacancy rate. So the gross income is $293,000, less expenses. And what are the expenses? You can see here on the right side, 1.25% taxes, miscellaneous expenses is repairs, utilities, and so on. And over here, you can or cannot, depends on the investor, put a management fee. Over here, I just put 3%, and the 3% is 3% of this. So this is something that goes inside. Okay, so far so good, hopefully everybody. Okay, so we're deducting the expenses. We have a net operating income of $179,000. Net operating income. Now, why this one is important? Because we're going to talk about cap rate. Everybody needs to know what is a cap rate. Jeff is asking, is 3% pretty standard rate for management? No. Oh, I put it in this case, but no. Usually it's between 5 to 6%. 10%. 5 to 6. 10% is fantastic. But no, 5 to 6. It's very competitive. I mean, I'm paying 3%, but I'm not an example. Okay, but 5 to 6%. But that's the customarily. But okay, so we have a cap rate. Now, this is most probably the most common indicator of if this is a good deal or not. You're going to hear it a lot. When you say to somebody, I have an investment property for you, he's going to ask you the first thing, what's the cap rate? So let's see what's the cap rate. You will see it's not a big deal to understand what's the cap rate. So what is the cap rate? Remember I said before, net operating income over this is $179,000, and which takes into consideration the net operating income over the price. Now you can see that I'm not taking into consideration right now the loan factor. There is no financing because cap doesn't include financing. And because everybody has his own financing, everybody has his own scenario. And when, for example, the seller wants to sell the property, he says, okay, this is the property and the cap rate is so and so. The seller doesn't know what's going to be the buyer's financing. Now, if the buyer buys it for cash, naturally the cap rate is the same as everything because there is no financing factor. So, cap rate, always remember, is the net operating income over the purchase price, over this one, okay? Over this, so that's, in our case, is $179,000 and a change over $3,050,000, which is 5.89. Questions so far, guys? Okay. Return cash on cash. That's another good factor, which is ROI. It's basically income over the out-of-pocket expense. This is a different formula. So let's talk about the out-of-pocket, the ROI, which I want you to remember. Now, I personally, I'm an ROI person. I'm not looking into caps. I'm looking in the ROI. So let me explain you what is the ROI. Okay, let me explain you how we calculate the ROI. So, ROI means the net cash flow. So basically, the cash in our pocket, which means that when we look before, I'll go back to the before, we had 179,000, right? But we have $135,000 for debt services, which means the paying off the mortgage. So when we're paying off the mortgage, this is the return on investment, but it's the interest and the principal. This is the interest and the principal. So you have to pay attention because this is a check the investors send out. So right now they don't care about their principal balance, they care about how much money they ditch out for holding the property. So in this case, since we took out $135,000, which is the factor of this 4.25%, we have $44,650 a year. Okay, that's our pre-tax of, and actually everything is before taxes. Okay, so that's the net ROI, the 44,000 over not what we bought it for. We don't care how much we bought it for. We care how much we put down. So that's $762,000. That's the 25% that we put down. Okay, so what do? Return on the investment. We are gaining $44,000 in our hand. We're holding $44,000, but we put $762,000. Okay, that's ROI. That's return on the investment. I love that. This is what I like. I'm very much in favor of the return on the investment. So I want you to always remember that. Now, naturally, the lower the interest rate and the better the terms the investor gets from his financial institution, this number is higher. The higher the interest rate, or the higher the worse the terms that the investor gets, this gun goes down. Okay? Everybody understand what I just said? Everybody has a question between ROI and cap. Okay? Everybody? You understand the differences? Beautiful. Okay, so let's talk about one more thing, which is very important. ROI including the loan. Now pay attention to what I'm just saying. So we have a $44,000. Okay, now the $44,000 is something that in our pocket. However, when we have $135,000 here, in that 135 we have interest and principal, right? So right now we have a loan that basically is $3,050,000 minus $762,000, which is about $2,500,000 something. Okay, so we have every year $38,000 goes towards the principal. Every year, $38,000. So in 3 years, give or take, we have $100,000. So the interest, the principal balance is not 2.5 something, it's 2.4 something. Now, a lot of people like to see this in their calculation, like money back to them, like money in the that owes them, which I can see that. So the way we do it, okay, we adding the principal reduction factor into your net income, into the net cash flow. Okay, so we're taking the $44,000, which we calculated the ROI, we adding the principal reduction factor, and we're getting $83,000. So we're taking the $83,000 over our return, the down payment, which is, for these purposes, is almost 11%. Another way to look at the investment. Everybody understood what I just said? Everybody understood what I just said? No. Okay, wonderful. Let's talk about other things. Let's talk about, I did cash flow. Let's talk about appreciation, okay? Let's talk about appreciation. Okay, so what's appreciation? We bought a property for, pay attention to what I'm just saying. So we bought a property for $3,050,000, okay? We put a down payment of 25% for $762,000. Let's assume that the annual appreciation is 5%, okay? Annual appreciation is 5%, which is nice, okay, not crazy, but nice. By the way, a property is appreciated, a commercial property, by two factors. One, the market, and second, by the cash flow. How good is the owner increasing the rent? So this is a very important factor when somebody is determining the purchase price. How good is the rent? And what is the market rent? But I don't want to go into that right now because I'm focusing on other things. So if we do a 5% of the $3,050,000, that's appreciation. Now appreciation is always on, we bought it for $1 and appreciated for 50%, so right now it's worth $1.5. So 5% is $152,000. Okay, so the property appreciated by $152,000, but it's so important. That's why a lot of investors don't like to put a big down payment. Okay, if you take the $152,000 by the $762, okay, you're getting 20%. So basically, this is how the investor is looking at it. The investor looking that he had the 20% appreciation on their investment. They don't care about the purchase price because they like to leverage. Leverage is to take as many loans as possible. This is the beauty. Pay attention to what I just said. A savvy investor do not care about the purchase price. The purchase price and the value, the total value of the property is only a factor for them to appreciate the return on the investment, because right now they have a 20% a year return on the investment, which is a $762,500. Who didn't get that? Not who got it. Who didn't get what I just said? Guys, ask me questions, please. Everybody understood that? Jeff is typing. Okay. Okay, I'm waiting for you guys. By the way, everybody saw my shirt? I'm very Hawaii today. Okay, so the mindset is to look at this more like a CD at the bank and looking at the growth of what your cash outlay was, not resale value. Not at all. Right now, we're not looking at resale value. We're looking at what our net portfolio is looking at. We have a cash flow for the two things that we spoke about. Very good question, Jeff. We have a little bit of cash flow. We put in a market. We can go to the supermarket with that. Okay, and in the same time, we have appreciation. This is growing and growing and growing. Okay, very good one. Now, in one of the sessions, this is you brought me a good point. I'll prepare a presentation why it's better to invest in real estate than to invest in the stock market. Good point, Jeff. Okay, anybody wants to ask another question before I move on? Okay, ready to move? Oh, Karen. Hi, Karen. I haven't seen you for a while. Looking good. We love Hawaii. Tax application. Hold on, Karen. We're getting there. Okay, so here we're going to the taxes, guys. Taxes, it's about depreciation. Okay, who can tell me what does it mean, depreciation? Anybody can tell me? value goes down. Okay, on book loss for aging of real estate, very good, very good. Loss of profit, no. Jeff was right. Okay, so depreciation, it's a beautiful, beautiful tax code. Okay, basically, the IRS comes to us and say, listen, you bought a piece of property, okay, and there is an aging for this property. We understand that. That's called the depreciation. And we will allow you, Mr. Investor, to reduce a certain amount of money every year from your taxable income because your property is being aged. Okay? It's a beautiful thing from the tax code. Why is that? Because it's a real expense, it's an expense in the books, but not out of money. No out of money. Okay? Beautiful. You will see that a lot of companies, a lot of, especially institutional investors, buying properties only for the depreciation. Okay? Only for the depreciation, and I'll explain you why. You can depreciate, and this is, and I'll explain you in a minute. Okay, so here's something that you go, and I picked it up from when you look at the property profile in the and the tax and with the title, you can see that the county is determining the value of a property by two factors. One is the land, and the other one is the improvement. You cannot depreciate the land. The land always stays the same. However, the improvement is something that you depreciate. Now, the tax code allows us to depreciate an improvement, a piece of real estate over 27 and a half years. Okay? So you take the amount of the improvement and you deduct, and you see which is $866,000 over here. This is 27 and a half years. You're getting to a tax write-off of $31,000 and a change. So basically, in the investor's books, he put $31,000 off, and he doesn't have to pay taxes on them. So if he made, let's say he made $100,000 net profit before taxes, he takes the $31,000 deducted, and now he owes his tax for his income for tax purposes. It's only about $70,000, not $100,000. Investors love it. Okay, they love it. Now, I mentioned before that a lot of institutions are looking for this depreciation because they're looking to places that they can lower the taxes. Now, it could be that many institutionals, because they don't have a good cash flow over there, after the depreciation, they're going to show a loss. But they love it because for banking purposes, the bank doesn't look at that because they don't care about depreciation. They care about the item before depreciation. But for tax purposes, they take that loss and carry that to another place. So that's institutional. Now, another trick I'm going to tell you. Institutionals, because they love the depreciations, they're going to look where this improvement is as high as possible. So basically, they don't care much about the land, they care much about the dwelling. So let me ask you, where do investor would like to invest? In Beverly Hills for $1 million or in Riverside for $1 million? Which one they like better? Investor for depreciation purposes. Can anybody answer me, please? Wanda say Riverside. Ahmad say Riverside. Okay. If you say Riverside, please explain why. Carmina said Beverly Hills. Okay. And my experience on the other side is the improvement are valued higher than land. Very good, Jeff. Jeff is correct. Because $1 million in Beverly Hills, it's basically, just I'm gonna exaggerate, is $900,000 is the land, and $100,000 is the improvements, the dwelling. We can depreciate on the dwelling, so we can depreciate only on $100,000. So the investor, when they look at Riverside, the land is not that much. So let's say the land is $200,000. And the value is, the dwelling is $900,000 or $800,000, and they depreciate on that. So they're looking for properties that they can depreciate as much as possible on the dwelling, on the building, not on the land. Okay? Everybody got that? This is tricky a little bit, but that's going to make you a great agent. Okay. Very good. Okay, let's go back to the last one. Okay, so everybody understood the cash flow. This is for mamas and papas, $44,000. This is what they want in the pocket. Okay, the 1031 exchange. Pay attention, guys. Okay, pay attention. 1031 exchange is not avoiding taxes. 1031 exchange is, by the way, Jeff, you're right. Okay, but I'm talking the example I wanted to show is only for the depreciation. So 1031 exchange is not avoiding taxes, it's deferred taxes. It's basically, instead of paying now, you're going to pay sometimes in hundreds of years. Nobody knows when. Because eventually somebody's going to pay, eventually. And the IRS has a lot of patience, okay? But they tell you, you don't pay now, pay later, as you go along. So let me tell you how does it work, okay? For example, we have a purchase price of $3 million, and we sold it after expenses for 4 million. So after the closing costs and so on and so on. Nobody cares right now about the financing. Nobody cares about the financing. So the investor made $1 million. So he takes the $1 million, and instead of paying taxes on the $1 million, he deferred that by putting the money, the $1 million, and all the proceeds from the transaction, he puts it in a company that called 1031 exchange. Okay, that's all this money has to go. Now I'm not going to talk too much about how it works and the timeline and everything. Okay, I don't want to touch it. But I want to show you the way it goes. So it's a little bit cut over there. Okay. So we have a $3 million purchase price. They put a down payment of 25% of $750. They sold it for $4 million. So what do we have? We have a $1 million profit, and we have the $750,000. The down payment that they put. So they have right now, they're taking $1.75 million and putting that in the exchange company. Now, but they sold it for $4 million. Why they don't take all the $4 million? Anybody can tell me why they're not taking all the $4 million? What happened to the rest of the money? Paid off the loan, exactly. It goes to third party. Okay, very good. So they paid off the loan. Jeff, you rock today. Okay, so they pay off the loan. So we have a $1.7 million that go to the exchange company. Now let me show you the beauty of this thing. Okay, so we have a tax deferment. In a certain amount of time, we have to invest in a different property. Now we go, and how do we do it? We had before $750,000, which we will be able, with the right leverage, to put it under a $3 million property. So now suddenly we have $1.75 million. So if we have a 25% ratio, which is a down payment, suddenly we take the 1.75, we divide it by 25% because that's the 25% we have to put it into a new property. Suddenly, we buy a $7 million property. Wow, the American dream. We started small, we appreciated, we did everything good, we sold it, we didn't pay taxes on it, and now we put it in a $7 million and we start all over again. Appreciation, depreciation, cash flow, and everything, it just becomes bigger. This is the American dream, guys. This is what makes this economy great. This is what millions of Americans are trying to do. You start small, you sell, defer the taxes, you go on and bigger and bigger and bigger and bigger, and this is what America makes it great. Any questions, guys? Any questions? Okay, no questions. Very good. So, I got a message here from...
Tell them to stay online for the clinic.
Kim is asking me to tell you to stay online for the clinic at 10 o'clock? 10:15? 10:15. Stick around, great clinic. Just improve your skills. Thank you so much, everybody. Have a wonderful Friday. Bye-bye.